The S&P 500 grew an impressive 23% in 2024 and a strong 8% annually over the last 20 years. Colloquially known as the market, the S&P 500 has such strong long-term growth that famous investors such as Warren Buffett recommend that most people should simply invest in an S&P 500 tracker, and many professional fund managers do not beat it consistently. However, while S&P 500 trackers such as SPY, IVV, and VOO deliver strong growth over the long term, they are relatively risky short-term investments. If you had invested $1,000 into an S&P 500 tracker 20 years ago, it would have returned $5,740 by the end of 2024. However, you would have stomached a max drawdown of negative 57% during the financial crisis, weathered swings in annual returns between minus 38 and plus 31%. And though on most days your investments would rise and fall between only minus 1 and plus 1%, you would have seen it drop by as much as 11% and rise by as much as 15% in a single day. Long-term dollar-cost average investing would have reduced the risk and increased the stability of returns. Considering the stock price over the last 20 years, if you had invested $1,000 every month for 10 years, you would have likely gotten an annual return between 10 and 14%, with a minimum of 8%, a fairly good return with no chance of negative returns. Had you only invested for 1 year, your annual return would have likely been between a broad range of minus 6 and plus 29%. And possibly as low as minus 55 and as high as plus 47%. That said, it would have performed well last year. Had you invested $1,000 every month in 2024, you would have had $13,300 at the end of the year. This is for educational purposes and is not investment advice.